JC Parets, founder of Eagle Bay Capital, a 10-year veteran of the markets, joining us here on the much anticipated Fed decision Thursday. JC, I bet you're just really excited about this Fed rate decision.
Yeah, I've been losing sleep over it like you wouldn't believe, guys. I mean, it's joking aside. I mean, the obsession with what the Federal Reserve is and this week. I mean, is uncanny. I mean, I just can't. I thank myself every single day that I'm a supply and demand guy. And I don't have to worry about any of this nonsense.
I mean, also you think about like a quarter point. For as much as rates have come down and as low as they've been for as long a time, is a quarter point, rate really going to make that much difference to the, I mean, what are you going to do? You going to pull all your money out of the stock market and go put it in CDs or what? I mean, it's just such a nominal difference here. But I know you've been a bomb.
I truthfully don't know. I truthfully don't know why today matters at all. I mean, I guess if you're a day trader and you want to, maybe fade a knee-jerk reaction or maybe anticipate one or something like that, if that's like, your strategy, that I think a day like today is probably a good thing. But for 99.99999% of the world, I mean, it's just the only people that benefit from something like this are the ones that get paid to sell advertising and, increase page views. I mean, that's it. For market participants, particularly, especially myself and, other supply and demand, investors that actually focus on, what moves markets, we don't care about this stuff.
Okay, JC, well, let's talk about the supply and demand and what charts are you looking at here, because we have had a nice little run up ahead of this Fed decision the last couple of days. Some stocks have been catching a bid, even some of the perennial losers, like we were looking at Caterpillar catching a $3 bid here the last couple of days, and it's been a while since it's been in favor here. Which stocks are you looking at and how are you playing it?
I think that I look at the overall market, as you guys know, and I think that's important. And, when you look at something like the S&P 500, for example, there's a lot of overhead supply. You look at something like Caterpillar, for example. Yeah, sure, we've had a nice week, terrific week in Caterpillar, and that can even keep going. I mean, I wouldn't be surprised if we see $80 in Caterpillar. And, if that's what you're trying to do, I think that that's great. But I think that there's just so much overhead supply in the market that I would rather be a seller of that strength instead of, trying to be cute and trying to buy this bounce, because I think that, the risk reward is difficult to manage. So for something like Caterpillar, where are you wrong? Below last week's lows? So you're going to buy it below, so the risk reward for me is just simply not there. And I think that there's just way too much overhead supply. So I think the best chart, if you're interested in the S&P 500 and U.S. equities, which a lot of people are, I think you have to look at dollar yen. I think that is really the big tell here. And, I'm a big intermarket guy. I'm a big weight of the evidence guy. The markets don't trade in a vacuum, I think was a great quote that I heard yesterday. If money's flowing out of something, it's going to somewhere else and vice versa. That's just the way, markets behave. It's all about money flow. And right now, yen has a very, very high, obnoxiously high negative correlation with the S&P 500, above negative 0.9 over the last month and over the last quarter, and then historically as well, as you guys know. And it's a much cleaner chart than the S&P 500. The S&P 500, you got a lot of room to the upside, a lot of room to the downside. It's kind of in no man's land. But if you look at dollar yen, it's a lot cleaner. So I think this 122 level in USD JPY is the big level that you want to look at if you're interested in knowing where the S&P 500 and U.S. equities are headed. I think if dollar yen can get above and stay above 122, I think that would be extremely positive for U.S. equities as a group. I think that would be very, very positive. Unfortunately, I think that the resolution out of this consolidation since last month is probably going to be to the downside. That's what I'm seeing. We're going to wait for a break. I don't know if you guys have the chart up, but, we've kind of been in a series of higher lows and lower highs really over the last 3 weeks or so. And those sort of quote-unquote pennant sort of formations tend to resolve in the direction of the underlying trend, and that has been to the downside since earlier last month. So, and you're trading right near a flat 200-day moving average, which you guys know how much I hate that. So, in all likelihood, I think we probably roll over and U.S. equities follow. But I like to keep an open mind, and if you're positive on U.S. equities, you want to see dollar yen take out 122.
Why the
Because when
yen?
money is
Why the yen, JC? Why? I mean, there's other currencies out there. Why? Why? What draws your focus and attention to the yen?
well, the negative correlation between, I'm talking about dollar yen, so yen is the denominator, but if you want to focus strictly on yen and U.S. stocks have a negative -0.9 correlation coefficient. They move completely inverse. So, you talk about safe haven trades. Safe haven, we know it's not gold. Safe haven, at times it can be the U.S. dollar. It can be U.S. Treasury bonds. But what it definitely is, 150%, is yen. When money is getting out of U.S. equities, it's getting out of risk assets, where it goes the fastest is yen. And that's why it has such a negative correlation. So if U.S. stocks are going to rally, yen's going to get slaughtered. That's just the way it is, and vice versa. If U.S. stocks are going to get slaughtered, money's going to flow into yen. So that's why I focus on the yen.
All right, go ahead, Dennis.
I was going to ask just why we're sticking with the currency. So I always like, getting an outlook on the Canadian dollar there, being Canadian myself. What are your thoughts, U.S. dollar, Canadian dollar exchange rate? Because we've been kind of hanging out at this 132 level for a long time here now.
Yeah, it's actually, I'm glad you brought that up because we exceeded those 2008 highs in USD CAD, and we've been consolidating really since last month in a very, very tight, pattern that tends to be continuation in nature. But in my experience, if this was going to be continuation in nature and we were going to continue higher, we would have already broken out. I think this is taking way too long. And right? I mean, take a look at that chart. I mean, you look at charts, right? If this was like a bullish pennant or, call it whatever you want, wouldn't it have already broken out? I just think it's taken way too long. You got bearish momentum divergences on daily and weekly time frames. Man, gun to my head, I think we break down here. I think CAD rallies.
So I should be maybe selling some more U.S. dollars and turning them to Canadian dollars.
It certainly looks like it, doesn't it?
Yeah, I agree with you here, and I've been taking a little bit off the table here now for the last little while here at 132. I just, you think about the run that we've had. It's been a pretty incredible year for the Canadian, or for the U.S. dollar against the Canadian dollar, because we were down at 110 when we started the year, and this is related to oil. I mean, when oil gets killed, the Canadian dollar gets killed here as well. But looking here, I agree with you. We've consolidated for a while, and we haven't broke out again here to the upside here, so maybe it's time to give back some of this run.
Yeah, it's not the cleanest. I think dollar yen is probably the cleanest, of all the major currencies. Definitely, actually, not probably. It definitely is.
JC, last week Goldman Sachs made a call for $20 oil. I don't know if they were talking their book or not. We made that low at $37.75 a week ago. We haven't been able to climb back into the $50 handle. Long period of consolidation there was resolved to the upside yesterday. Do you see any follow through in this crude rally, or is Goldman Sachs right on that call, and we're going to be heading quite a bit lower in the oil patch?
Yeah, I mean, I don't know what Goldman Sachs, I don't know what their motivations are. You know me, I try to, avoid what the sell side thinks. I mean, there's the conflicts of interest there. I mean, forget about it. But, I think that we do have some more legs to the upside. We're kind of in no man's land right in the middle. The bounce, last month, the low didn't just come at a random area. That was exactly the 161.8% Fibonacci extension of that entire consolidation since 2010, that broke down last year. I mean, to the freaking penny. So, you can't draw it up any cleaner than that. So that bounce did come from an important level right around $38. But the problem is you have that overhead supply from former support in January and March, right? So what was support, and you remember back in March when I loved oil, when we got back above the January lows, I said you had to buy it aggressively for a mean reversion. I mean, that was a great trade, especially with dollar weakness. That just made a lot of sense. But that level, if you recall how much we were pounding the table on that level, that broke down in July. So that former support now becomes overhead supply. So we're talking about, 52, 53, something like that. And then we're also where we have a downward sloping 200-day moving average. So any longs, I would be fading into that level, into the 52, 53 level, something like that. So in terms of buying it, I've liked it against the lows from earlier in September, so around $43, and that consolidation that you were just talking about. I think you could still own it against that. You don't want to own it if it breaks down below that, because then we'll probably head for another leg lower, and Goldman Sachs perhaps might be right, and be able to take advantage of what they're probably short. If you're a conspiracy theorist out there and you think they're talking their book, I don't know. So right here, I think we're in no man's land. You could buy it against that 43, but I'd be fading 52, 53-ish. That's what I think about oil.
Help me out on this Apple chart here. Has had just a great run here since it made that 92 bottom. I know you were looking to rally to short this thing into strength here. 1689 you hit on Tuesday, on Monday. 1653 2 days ago. 1654 yesterday. Two closes right at 1628, 1641. Only a $1.02 range here in Apple. Does it beat your objectives for a potential short? You're looking to short it on weakness. What do you make of that tight range from yesterday?
I think the whole market was in the tight range, and Apple has a really high correlation with it, so I don't think it's surprising that it was in the tight range. I think, we hit our downside target. You guys know, we like to short, once we broke 119, which had been former resistance in the fourth quarter last year, and where we broke out from in early February, when, on this show, we were talking about buying that breakout, and fading it and selling it at 129. I mean, that was a great trade. You guys remember that? So that breakout level, the reason I liked it, in early February was because there was overhead supply, and once that was exceeded, we knew that demand, exceeded supply, and we wanted to take advantage of that. So that level, there's a lot of market memory there. So 120, that's the big level. So I'd be fading that. If you didn't sell it the entire time since February that we're saying to sell it, and you've been stuck in it, quote unquote. I hate using that, but that's where I'd be a seller. I don't necessarily know that I would short it there. I'll worry about it when the time comes, but I think it's probably a good entry point as a short. You get up there and you fade that. Maybe you sell calls, maybe you buy puts, maybe you short it, directly. There's a lot of different ways to do it. We'll be near a flat 200-day moving average. We'll be right near former resistance and new support from when we broke down. About 6 weeks ago or so. So I think it'd probably be a good area. I'd rather be kind of like a seller of calls. I think would probably be the best strategy if and when we do get up there. I'll worry about it when the time comes. But it seems to me that that's probably the best bet, because if we get up there, I think it'll be difficult to get through. I don't know how much downside it has, but because it's difficult to get through, I think that you can make money on the premium deterioration. So in terms of what vehicle to use and how to take advantage of strength if we get up to 120, I think that's probably our best bet.
Selling calls. What about Twitter? What are your thoughts here? 7-8 trading sessions here. We've been very quiet on this one, and I think eventually it's going to have a move.
They haven't been bought out yet? They didn't get bought out like everybody said they would?
Yeah, we haven't seen the buy. We haven't seen that. We haven't even seen the new CEO put in place there permanently yet. But in any regards here, what are your thoughts here on Twitter? We've had 7-8 trading sessions where we've had some quiet consolidation here. Where do you think this is going to resolve, to the upside or the downside?
I don't know. Probably to the upside. I just don't like it. It's just such a no man's land. I mean, we came crashing down when all the journalists were, pounding the table about how their sources were saying how they were going to get bought out. I mean, we're talking this is $38, and then the stock essentially got cut in half after that. So those sources must have not been very good. Supply and demand said to fade it. The sources said, quote unquote, to buy it. So again, supply and demand wins once again. We came crashing down and we bounced. I mean, I don't know. Is this really the one you want to buy? I mean, where are you going to buy it against? I mean, I could see potentially being long against, 2680, something like that, which were the lows in early August, and being long only above that, and then maybe fading at around 33 or something like that. I could see that. I just think you're forcing it. I mean, I guess you can make a solid argument to trade it against that, and quite frankly, the risk reward is skewed in favor of the bulls, no doubt about it. But there's got to be an easier trade out there. I mean, if you're looking across the market and that's the trade that you're going to make, fine. I just think there's easier stuff out there. And if there isn't, you don't have to trade.
Right. I've been looking at this one here. I've been dabbling in and out of it, and I don't know. Maybe they got me yesterday. 1, 2, 3, 4, 5, 6 highs in a row within a 30-cent range between 27.55 and 85. You printed 28 yesterday, and you closed in the upper quadrant there above those. So I'm holding on here now. I'm a little bit shorter term than you. I don't know. I think might be a nice pin in the option markets on this on 28. So I gave myself a little bit more time on this. So I think once this clears 28, I see a minor stopping point at 28 and 55, and then up to 29. But it's just critical. I mean, you just got to get those shorts out of there that are holding under 28. That seems to be the pin in it. JC, just the financials. Any comment on any of the financials? I mean, supposedly, if interest rates go up, it's supposed to be good for the banks and the money centers. Any comments on that?
Yeah, I don't know if I buy that whole if interest rates are going up, it's good for the banks. And number one, interest rates haven't been going up. So, I never understood that. But, again, getting back to what we were talking about Caterpillar and some of the and oil, there's just so much overhead supply in financials. Financials broke down.
Mm-hmm.
Number one, they broke their uptrend line from the 2009 lows. If you draw that, I mean, that was earlier in the year, and that was problem number one. And then they consolidated sideways and were really just a hot mess, very similar to Apple, just kind of a mess, trading sideways. And then that resolution, instead of resolving to the upside, like bullish continuation patterns should, they broke down. So the market spoke, and all of that broken support now becomes overhead supply. So, again, getting back to that theme of rather than trying to buy dips, I'd rather be selling strength. I can make the same argument for financials. You look at XLF, look at 24 and a half, and getting back to that theory about, banks benefiting from higher interest rates, look at regional banks. I mean, talk about a beautiful failed breakout. I mean, you can't draw it up any cleaner than that. You had regional banks breaking out in June above those highs, consolidated for a couple of months and then broke down. So, I think if you look at KRE, which is the regional bank index, which are the ones that, the fundamental analysts would tell you would benefit the most from higher interest rates, you're trading right near a flat 200-day moving average, which, really creates headaches. As, I always tell you guys, I'd be fading that around 42 and a half, 43, which was that form of resistance that turned into support that broke down last month. So, again, just way too much overhead supply to be aggressively buying, banks right now. I'd rather be fading strength, at least for now. Let them prove otherwise. I'm more than willing to change my mind. I'm not one of these guys that's gonna, tell you to buy gold in 1900, and then here we are at 1,000. Still pounding the table that I'm right, even though silver's down 70%. I'm not one of those guys. If I'm wrong and the market proves otherwise, I'll change my mind. But for right now, that overhead supply annoys the hell out of me.
JC, 1 minute left here. Just quickly from the chat, Shervin wants to know your thoughts on the TLT.
So Shervin, I don't know if I pronounced that right. I put something up there yesterday. I think I've done a pretty good job, of navigating TLT, pretty well throughout the summer. Maybe not so much execution-wise, but, analytically, I think that, I've got the levels, pretty down. So you can go to the blog, allstarcharts.com, and I laid out those levels. I'm looking at 118 and 125. So here we are near 118. To me, that is key support. That goes back to last November. That was resistance throughout June and July, and then we broke out in mid-July and got that explosive rally. It hit our upside target, and then since then, I've wanted to back off. I felt that it was dead money. But now that we're back down here, towards the lower end of that range, I can see that, especially like a day like today, if you're a short-term trader, if there's a knee-jerk reaction where, they sell bonds for whatever the reason, and we get below 118, 118, 118 and a half, and then rally back above that, I think that's your entry, and you can get long right there against 118. That would be the best case scenario if you're a short-term trader, but then I would be fading 125 because that's the upper end of the range. So I think that for right now, that's the range. If you're a longer-term investor, someone who looks out weeks and months rather than hours and days, I think that this is dead money. They hit our upside target and back off. So I think it just depends on what your time horizon is.
We've been on the line with JC Parets. He's the founder of Eagle Bay Capital. Joins us every Thursday to give us his technical take on the market. Thanks a lot, JC. We'll talk to you again soon.
Appreciate it. Thanks for having me, guys. Have a good one.